guys who don't know, Brian Shannon, really is a pioneer, in my eyes. This guy is someone who's become a friend of mine over the years. And really, I look to him as a mentor. I always have. This guy was making YouTube videos on technical analysis, talking about what happened during the trading day in 2005. I mean, in internet years. Think about how long ago that is in internet years. And Brian Shannon truly is a pioneer when it comes to fusing together technical analysis and social media. And I've personally learned a ton from him. In fact, I incorporate multiple time frames in my analysis every single day of my life, and that's something that I learned from Brian. There's no doubt about it. Brian, are you there? Can you hear me?
I am here, yes. Can you hear me?
I hear you. I hear you loud and clear. Just wanted to share with the audience, what a huge fan I am of yours, and I'll let you do your thing.
Well, thank you very much, JC, for putting this together, and we are a part of the Mutual Admiration Society because I have a lot of respect for what you do as well. And following up with what Joe said, thanks a lot for putting this together. You've got an amazing event here and a lot of people. I know we have limited time, so I'm not going to go through a whole introduction of who I am and that sort of thing and be promotional. What we're going to talk about is the volume-weighted average price. This is something I've been talking about. I kind of stumbled onto it actually in my Realtic trading software probably about 16 years ago, and I really wasn't sure what it was. There wasn't much information about what the volume weighted average price was out there, so I started playing around with it, and over the years I've developed some strategies and ways of looking at it that have really been helpful to not only making money in the market, but avoiding losing situations. Before we get right into the volume-weighted average price itself, I think that, regardless of what your personal time frame is, I know there's people here who are day traders, people who are swing trading, and maybe people who are longer-term buy and hold investors. You've got to have a fundamental understanding of market structure and how money moves in and out of the markets. We're obviously in a stage 2 uptrend right now, meaning a bull market, but eventually this market is going to have its day, just like every stock has its day, where it is in a downtrend. And people, what was 6 years ago? I mean, I know JC, that you were pointing out to a lot of people, rightfully so, that Apple is just one stock, and when it's in a downtrend, why obsess with Apple when there are so many good stocks out there climbing that the higher highs and higher lows? Avoid the stocks in the stage 4 decline. Wait for them to undergo accumulation, and when they enter that bullish environment for whatever time frame it is that you're involved in, forget about the FOMO. Wait for fear of missing out. Wait for actual price evidence. As I always like to say, only price pays. And a lot of people say, well, what do you mean by that? What I mean by that is, it can have the best story in the world, or an analyst can upgrade them, or they might have the best earnings out there. But if the price is going down, everything else is completely irrelevant. As JC points out, people are, the news is there to sell news stories. They're not there because they're making money and trying to help you make money. They're there to get ratings and to sell advertisings on their network. Sometimes they have great information that can be helpful, but most of the time, if you just defer to price action and listen to the message of the market and know where you are within the overall cycle for your time frame, you're going to come out way ahead of what you might normally do. So when it comes to measuring these cycles, the cyclical flow of money through the market, in and out, one of the easiest ways to do that is with moving averages. A moving average is simply a mathematical trend line. It takes the average of a certain number of periods and then puts that on a line so it smooths out the price trends. The most common types of, there's a lot of different offset, differential type moving averages. The most commonly used are a simple moving average. Each, let's say you have a 10-day moving average. You take the closing price of the last 10 days and simply divide it by 10, and that's your first period. As you go to day 11, Day 1 drops off in the calculation, and now you're averaging the price of day 2 through 11. That's how it gets its moving property, because it's dropping pieces of information off. So the simple, as the name says, is very simple to calculate. The exponential is something that's quite popular, and what it does is it weighs the more recent data with a heavier rating in that. So I'm going to completely make this up. In the case of a simple moving average, each period that you're averaging gets 10% weighting. In an exponential moving average, the 10th day, the most recent day, will give maybe 12%, versus day 1 will give 8%. So the older data gets less influence in that calculation. Now, just real quick there on those two, I personally think that it's completely irrelevant if you use a simple or exponential moving average. The reason I say that is because what I'm looking for with a moving average is to look at it as a reference point, just something to compare price to, not an action point, but a level to say, okay, the stock is at this moving average. Let's say it's a 50-day simple or 50-day exponential moving average. What that tells me is it's pulled back, let's say on light volume, to that moving average, and it tells me I want to take a closer look. It doesn't tell me I want to buy there. It tells me I want to drill down to shorter term time frames and look for evidence that the buyers are in fact showing up. Look for evidence that the sellers are slowing their activities and the stock is finding support. Then on those shorter term time frames, I want to look for and come up with my plan and establish what's a good risk reward in here. Where do I take my action? Where do I participate? Where do I set my stop in case I'm wrong? So again, it's irrelevant whether you use simple or exponential to me in the way that I use them as a reference point. The volume weighted average price is different. It gives more weight to the actual volume traded rather than time. So what it does, and we can look, let me go ahead one, the way that it's calculated is it's the average price per share during the time studied. You can be studying a one-day chart, you can be studying year-to-date, you can be studying for the last 5 years. What it does is it takes up the number of shares at that price, multiplies them together. So if you have 6,000 shares traded at $20.05, that's $120,000 worth of stock. And if you have 1,000 shares at 2065, so these price points, in other words, if you add them up, 2005, 2015, 2020, and 2065, the average of those is $20.26. So if you were calculating a moving average, the number of shares traded, because the majority of the shares were traded at 2005, 6,000 shares were, the dollar cost, the dollar value, 221,000, says that the average price paid during this time is $20.14. So it gives you a more accurate understanding of the psychology of the participants. Who's in control? Where do the buyers have that control? And so it gives us a better understanding of what the price action is. So that's how it's calculated. Now, traditionally, the way that volume-weighted average price has been used is really as a measurement for institutional traders of efficiency for an order. So let's say you have XYZ hedge fund and you go to your broker at Goldman Sachs and you say, listen, I need to buy 250,000 shares of Microsoft today. And they'll say, okay, we will guarantee you the VWAP. So I guess I should know what the price of Microsoft is right now, but I don't. I know it's at an all-time high. Let's say it's $110 a share. So if the average price during the day was 110, the high might have been 109 and the high 111.15. So the way that I'm going to look at this at Goldman Sachs is, if I'm going to guarantee them the volume weighted average price, which was 110, and I don't know that at the beginning of the day, I can either guarantee them that volume weighted average price, or I can say, listen, we'll buy you the 250,000 shares on a best efforts basis. So if my best effort comes in and says I bought it at $100.50 a share, Well, the hedge fund guy is going to say, wait a minute, VWAP was 110. You're completely screwed up. You ripped me off basically for 50 cents a share. I'm not doing business with you again. I'm going to these guys instead. So it's a way for them to measure accurately what, how efficient were they in the order. Now, if Goldman Sachs says, listen, we'll guarantee you the volume weighted average price for today. We don't know what it's going to be, but let's say it's 110. So let's say we get one of our analysts to whisper there's a problem, and I guess I shouldn't make stuff up like that, but let's say we get the stock to open lower. Let's say we sell short 50,000 shares to scare people in the morning, and we open the stock down at 109, and at between 109 and 109.80, we're able to buy 300,000 shares. So we bought all the shares for that order, plus we covered our 50,000 shares short, and our average price maybe was 109.57. So if I guaranteed the brokerage for the customer of the hedge fund the VWAP, well, I just beat VWAP by 53 cents a share. That's how Goldman Sachs can make extra trading profits, because they're not obligated to pass that on. They did better efficient trading. So it's a lot of times the basis for algorithmic trades, because they have the VWAP splitters that will slice out portions of the day and say, here's where 10% of the volume typically occurs during the day. So our program will buy 10% in that period. As this period picks up and 20% of average daily volume is done in there, we'll do 20% and try to use it around that volume weighted average price. So the VWAP during the day emerges and tells us who's in control, the buyers or the sellers. It's a great reference point to determine value for if it's that day, from the beginning of the day. So that would be, as I say here, since the event could be the open, since the 9:30 open. What is the average price? It could be week to date, month to date. It could be since any type of event, such as we'll talk about some examples with IPOs, or since earnings, or some kind of gap. It can be used on any time frame. As you go out to larger time frames, like as with any moving average, the sensitivity slows down because you have more data to average. So the new data doesn't account for is much weighting, and which kind of makes me think, I'm surprised that no one's come up with an exponential volume weighted average price, but that's just a different thought. Anyways, the way it's traditionally measured to get it most accurate would be with tick charts. Now, tick charts, again, it's kind of like a simple versus an exponential moving average. It's not 100% accurate. We're just looking at an average area. A lot of times what you'll see is that where there's no other traditional support or resistance that you would look at your chart, you'll see that oftentimes it will act as a hidden level of support or resistance. There are institutions out there that will buy Facebook every single day of the year. They will say, we want to buy it. We don't want to move the market, but we want to buy it when it gets to volume weighted average price. So if it comes down to volume weighted average price, they will continue to buy shares, and that's an example we're going to look at. So as I said, it's more responsive to volume than it is to price. It's not the magic indicator. It's just one more piece of a very complicated puzzle, and that puzzle, of course, is the market. So we've gone over how it's calculated. Now, this is something that if you think about moving averages, as I was alluding to a 50-day moving average before, they often act as support or resistance, support in an uptrend or resistance in a downtrend. It doesn't mean you just blindly buy at a 50-day moving average when it pulls back there. It doesn't mean you sell short as it rallies up to that 50-day moving average. What it means is it's a place to look more closely at the action on a shorter term time frame. We want to be aware of the direction of the 50-day moving average. When we have the prices above a rising 50-day moving average, it's innocent until proven guilty. As the trend flattens out, we're more neutral, but then as it declines, it's guilty till proven innocent. So we look at these rally attempts, and we certainly don't want to chase them, especially after you have to ask yourself always, where has the stock come from? Where does it have the potential to go? If it's just expended all this energy moving up to that 50-day moving average, you don't want to be the guy that buys it, especially when that 50-day trend is still lower. So there is a self-fulfilling tendency for moving averages, and you have to understand why. It comes down to the psychology of the participants. If you're an institution that owns a big chunk of the stock, and let's say you're selling out small pieces on the rallies, and then as it pulls back to its 50-day moving average, you're no longer selling, number one, so you're removing your source of supply. Number two, you might be thinking, you know what, I'm going to replace half of those shares that I sold. If I sold 100,000 shares on that rally, I'm going to replace up to 50,000 shares as it pulls back because I still like the longer term trend. So you will start to not only remove your supply from the market, but you will add demand down near that 50-day moving average. So think of the people who were short this market. A lot of hedge funds will short, as they see the stock rally, let's say 10% starts to pull back, they'll short it over in this area for a couple day hold, and they'll say, we're going to cover near that 50-day moving average because the 50-day moving average tends to act as support. So they're adding supply up here, and they're pushing it lower, and as it gets down towards that 50-day moving average, they're not only not adding supply to the market anymore, but instead they've flipped. That seller has now become a bidder for the stock. So they're bidding into that stock near that 50-day moving average because the 50-day moving average tends to act as support. So they say, let's cover our position or part of our position there. So it forms a picture of more demand in this area and less supply. If you just think about the three positions that anyone can have in a market, you can be long, you can be short, or you can be in cash. So if you're long, maybe you've sold some on rallies and you're adding to it on the pullback. If you got short up here, maybe you're looking to cover. If you're in sidelines, on the sidelines in cash saying, oh boy, that's a good trend, I like that one, I'm going to watch that one, but I'm not going to participate till it gets down towards that 50-day moving average. And you'll have different institutions, individual investors, pensions that will say, you know what, we don't have a position in this. Let's start bidding for some stock near that 50-day moving average. More demand, less supply. The stock finds equilibrium near that 50-day moving average, and not all the time. That's why we look at it on a shorter term time frame to look for actual evidence. In the downtrend, it's just the opposite. The shorts, got involved over here, let's say. They start to cover, bargain hunters come in, it rallies up, and the longs say, hey, it's at that declining 50-day moving average. Let's start to take some profits here. It often acts as resistance. So more supply. And then you have the guys who covered their shorts down here go, let's try that again. We've got this prior support over here. We've got the declining 50-day moving average. It's often acts as resistance. Let's put some supply out there and short this thing. And then you might have just people inside in cash looking to do the same thing as well and participate on the sidelines. So moving averages, if you understand the psychology of buyers, sellers, and people on the sidelines in cash, that's how you can get a better feel for what would I be doing if I was long? What would I be doing if I was short? If I had a $10 billion fund and I was, picking up bargains down here and it rallies 10% in 3 days, 5 days, maybe I'll take a little bit off. Why wouldn't I? Because I know that the trend is lower, but I'm looking to establish a larger position over time, so I'll replace those with smaller, lower price shares. If we look at just one moving average, it can be a simple moving average, exponential, volume weighted, or some displaced moving average, whatever you want. It just keeps the analysis really simple. A rising moving average indicates positive price action. Innocent till proven guilty is the way I look at those. In a declining environment, the moving average is making lower highs and lower lows. It's trending from upper left to lower right. In other words, in a downtrend, it's guilty till proven innocent. Money's flowing out of that. So why on earth would you want to be a buyer when the average price is declining? Rallies with a declining moving average are treated as bounces within a downtrend, guilty till proven innocent, highly likely to fail. Not always, but highly likely. And investing and trading is about probabilities, not certainties. So we want to say, what's most likely to occur? How do I position myself with what the overall market trend is? So be aware of the direction of the moving average. This is one that gets a lot of people. The semiconductors were, this year, gone below their 50-day, or actually last year, they were, I think they were up 28%, the semiconductors. And people kept calling the end of the rally just because they went below their 50-day moving average. There were about 3 different occasions where they went below the 50-day moving average. But that 50-day moving average was advancing, and the people who sold short or sold their position scrambled to get their positions back because the semiconductors continue to make all-time highs, and we have higher highs and higher lows, obviously. So that market is going to be one that continues to torment short sellers, just like the S&P 500, just like the NASDAQ right now. We're all in uptrends. Selling short is just a foolish thing to do. So my belief is that the most important for swing trades is the 5-day moving average, the direction of the 5-day moving average. And when you initiate a trade, it should be in the direction of the daily volume weighted average price. Like any form of support or resistance, the more times that they're tested, the weaker they become, the more likely they are to fail. Not more likely, not certain, but more likely. And using Facebook, we'll see more likely, not certainly. So for day trades, again, and that's not the focus of this material, you want to trade in the direction of the daily volume weighted average price. If the volume weighted average price is declining like it was on Friday for the S&P 500, it basically tells you, okay, today there's just a little bit of profit taking because when we look at the bigger picture, we're still in a primary uptrend. So we want to either avoid shorts or just sit on the sidelines and wait for better pricing. But if you're an aggressive day trader, maybe you want to sell short and scalp in the direction of the VWAP. To me, that's kind of a waste of time, just scalping for nickels and dimes. But be aware of the direction of the volume weighted average price. If you get a move, so if you have a declining volume weighted average price, but the stock rises above it briefly, but the direction of that VWAP is lower, most likely that rally will fail. What I like to look for is a flat to advancing volume weighted average price or flat to advancing 5-day moving average before I decide to look for a long. And the opposite would be true for the short side. So here's the fun part, is where we get to look at some examples. And I've got about 5 or 6 of these, and then we're going to have some questions. So this is the S&P 500, and this is 2016 right here, the beginning of 2016. And you can see this purple line right here. That's the volume weighted average price that I've anchored to the beginning of that year. So as we started out 2016, we were trapped underneath that volume weighted average price, meaning the average price for the year on the second day of the year, third day, fourth day, fifth day, sixth, seventh, eighth, was declining. Now we got above that VWAP for a while, but then it continued, but the trend, it was still declining. Over here, when we got above that volume weighted average price for the year, and then we took out this little double top, right? I'm sorry, we completed this double bottom by moving beyond 195. The buyers took control. The volume weighted average price for the year continued to rally. So then we had, right in here, we had Brexit. And Brexit in June had this large decline. And by the way, this chart, just so it shows up more clearly, each one of these candles represents 2 days worth of data. If you're looking at it funny, thinking that's not the way I remember it, that's because each candle here represents 2 days. Anyways, when we saw the shock from Brexit, we saw that it came right down to, and follow my mouse with me right here, right to the volume weighted average price year to date at that time. And after that little fearful flush, the market soared from there. And then it pulled back before the election. Prior to the election, it pulled back. And if you take a look at the volume weighted average price from the low of 2016, it came in within pennies of that before the rally. Right now, I think one of the more important volume weighted average price events you can look at for the S&P 500 is since the election. That's been an emotional, it brought a lot of volume and emotion, and this is a measurement of the average price for the S&P 500 since the election. And what's the trend of that average price? It continues to move higher. So the breakout this past week in the S&P 500 should not have come as a surprise, because consolidations in a primary uptrend on the longer term time frame tend to resolve in the direction of the primary trend, which is obviously higher. And the average price the S&P 500 has been trading at since that election is also advancing. So the path of least resistance continues to be higher. To short this market for anything more than 1 to 2 days is really just kind of a foolish type of thing to do. So if we look at Facebook, as I mentioned, now January of 16, like the market, Facebook fell down. Then it had this huge rally here, kind of got ahead of itself, found its footing near that volume weighted average price year to date. Buyers took control. It pulled back almost to the penny, and the buyers took control mid-April. Once again, strong rally. It came down and tested that volume weighted average price. So if you're looking at this, you wouldn't have seen any of the data on the right, of course. This unfolds day by day, and it bounced, within $1 or so, super strong bounce, and got overextended, pulled back, strong pullback. But where did the buyers emerge? Right at that volume weighted average price. Another rally which made a lower high, support found at that volume weighted average price. And then again, right at the end of the year, and now we have this next bounce, which has obviously been a tremendous rally from 115 to 132, great percentage move. We'll continue to see if that acts as an important level. I would also say that you would want to put a year-to-date volume-weighted average price on Facebook, and you can use this as, maybe even a stop level or an area to accumulate. It depends on your personal strategy. I'm not here to promote a strategy today. My preferred strategy is swing trading, but I'm giving you the information to encourage you to open your mind and say, what can I do with this tool? NVIDIA is a great example, because this is one that I've been talking about. I tweeted about it over here on this day and said, this chart looks like Qualcomm did back in 1999. And all kinds of people say, well, that's crazy. They're completely different businesses. And my response to that was, I wasn't talking about their businesses. I wasn't talking about what they do or their earnings. I'm talking about the chart pattern that we've had this somewhat parabolic move. It looks like it's due for a pullback. The next day it gapped up and pulled back deeply. And as it pulled back, I said, the most important level I'm going to be watching will be the volume weighted average price from this big gap over here. So this was November 11th. And in this area, I was saying it looks like that will be the level that we want to see tested. And you can see that the volume weighted average price was tested within 50 cents, I think it was, which on a $100 stock is pretty darn accurate. And this is where the bounce began. Now, when it bounced, I said, let's be aware of the volume weighted average price from this event, this gap, because it acted as resistance. In the declining volume weighted average price from that event acted as resistance here. It acted as resistance here. Now we're going to look for a bounce up to that level. It came right up to it, pulled back, made a higher low, and then 2 days ago it broke back above that. So it made a higher high with this higher low below it, and it came down and tested that volume weighted average price, which was resistance, and held as support. And now NVIDIA is on its way. I would say that you could either use this volume weighted average price for a stop, or put a volume weighted average price from this low, and you'll see that it's continuing to hold above that. And if you look at Friday, yesterday's action in NVIDIA, this is a 2-minute chart. So each one of these candles represents 2 minutes. This was Thursday at the close right here. Friday it gapped higher. I put a volume weighted average price on there, and you can see it kind of struggled here a little bit. The VWAP was declining right even before this drop, But then as the volume weighted average price flattened out and the stock made a higher high above it, the buyers took control right there at 109.80-ish, and the stock continued to rally 2 points from there, higher highs and higher lows. Don't fight the direction of the volume weighted average price. If you're a day trader, you've got no business buying it on the way down because you don't know if it's going to continue. So you're either short for a scalp if that's your preferred strategy. But again, going back to the bigger picture, it would say you got to be foolish to short this stock and expect to make much. So you sit on the sidelines in cash and wait, and as the stock rallies, you participate, and then you exit wherever your personal strategy says. Maybe it's beneath one of these higher lows on this time frame. Either way, don't fight the direction of the volume weighted average price. IPOs, I've been talking about, I've spoken for the last couple of years about the Alibaba IPO and its volume weighted average price since coming public. Now this is a weekly chart, and you can see it opened real strong and then pulled back for about 4 or 5 weeks. Then the buyers regained control as it got back above the average price. So what that means right here is once it got above that level, the average participant in the stock was no longer losing money. They were in a position where they were gaining. The trend was turning higher, so people piled in, shorts got squeezed. It pulled back to that VWAP, and it never, down in here, this is where you would start to study it on a shorter term time frame and say maybe if it gets back above this little lower high. So we have this high, we have a lower high, we have a lower high, and these are weeks, keep in mind. If it got back above that, then it most likely would have continued. Instead, it broke down, rallied up, and found resistance at the volume weighted average price since the IPO. Strong sell-off rally that came up short of that VWAP. It came down, formed a double bottom, and that double bottom was violated right here at 85. So 65 to 85 is a 25-point move. Add 25 points, and the price objective was hit within 6 weeks here after reclaiming that volume weighted average price. So it's a complementary tool. It's not meant as necessarily a system, but when you see that this prior resistance is broken and we have a higher low, we have a double bottom, we have the confirmation that double bottom is breaking, the stock goes on 25 points as it's supposed to based on the measured move of that double bottom. If we look at just yesterday, there were 2 IPOs that came public. One was REVG. The stock opened and immediately sold off strong. So it opened near 25.75, came down real strong to 24.50, started to find some resistance at the VWAP, and then buyers took control right here but couldn't keep control, and the stock stayed below its volume weighted average price. So the average participant who owns REVG in the aftermarket right now owns it at 25.25. So the average person is down in the stock. Compare that to JELD. Now JELD, similar price stock, it opened at 25.5, pulled back to 25, reclaimed that volume weighted average price, and from there you can see the volume weighted average price rally, continued to rally, and the stock made higher highs and higher lows, and would have been a good way to trade an IPO that just freshly came public. This is the only information we really have to say who's in control, buyers or sellers. What's the average price doing in here? So if you're an aggressive day trader looking at a 1 minute or 2 minute chart and using the volume weighted average price is a good way to look at how to trade an IPO. So what have we learned? One, the volume weighted average price, it can be useful for time frames all the way out to multiple years, such as the Alibaba IPO. It can be used for day trades like NVIDIA. It's a quick, easy way to visualize who's in control for that time frame being studied. Are the buyers in control or the sellers are in control? What is the trend? If you trade in the direction of the volume weighted average price, you're going to be on the right side of the market. It doesn't mean you're not going to experience pullbacks. You still have to use common sense and ask yourself, where has it come from? Where does it have the potential to go? So you can determine whether the trade buying right there at that point is a good risk reward. That's more about timing. This presentation today is about a tool that can help you. So if you look at the volume weighted average price from the event, it can help us understand the emotional disposition of the participants. Events might be the open of the trading day, the volume weighted average price since earnings, the year to date, since a certain gap, since a breakout past resistance, since a breakdown from support. I've used it for determining, after Federal Reserve announcements, FDA reports, and really what it's very good for as well is with short squeezes and to try to determine where the shorts are positioned. What's their average price? That's something I talk about in a different course and just more detailed, obviously, than what we're going to get into, what we're concluding here today. Anyway, you can use it from any significant event where there's emotion involved, and it'll help keep you more objective so that you're not chasing moves and you're not buying a pullback that's going to continue to pull back. You want to be with the primary trend, obviously, but then short-term timing allows you to participate in that longer-term trend with short-term timing. So we want to anticipate and decide when to participate, exit, and avoid. So we anticipate the trade setting up and we prepare for it on the longer-term time frame. We drill down to a shorter-term time frame to say, now where's my risk reward? And then as we start to monitor on those shorter term time frames, we participate and we either get stopped out with a small loss, or we then manage the trade, raise our stops, and listen to the message of the market. The point is, any significant event you can imagine, you can measure the volume weighted average price from, and if it has significance, it will often give you a very objective guideline to say who's in control, buyers or sellers. So thanks for attending. As I always say, only price pays, as I mentioned at the beginning. By the way, the charting package that I use to find the volume weighted average price, email me and I'll send you a $25 coupon off for it. It's only about $40 a month anyways, but JC, how are we doing here? Good?
We got a couple of minutes. I'm glad that you mentioned the charting software. I know I'm seeing on the chat everyone's so excited. Everyone seems to be thrilled learning about VWAP. I know I personally learned VWAP from you over a decade ago. So I appreciate you bringing up the charting platform. Just go ahead and email Brian, and he'll set you up, guys. But something else that I wanted to mention, I found your book to be such a huge value add, and I know clearly, the audience is obviously has turned into a huge fan of yours. You want to talk about a little bit about your book and how people can get their hands on that?
Yeah, well, it's called Technical Analysis Using Multiple Time Frames. It's funny that JC was just off on vacation, and he was adamant that he needed it FedEx to him before he went to his vacation, and that's how
you had just published it as soon as I finished my CMT level 3. So this had to have been summer of '08, right?
Yeah, exactly.
And I was leaving to Italy, I believe.
And he was adamant, you need to FedEx it, doesn't matter what it costs, I want it. I said, okay, well, let's set this up. And I was thinking, this guy's nuts, holy moly. But I'm glad it was worth it, JC. I mean, yeah, it was published in '08, and I mean, there's still, it's technical analysis using multiple time frames, so it's about drilling down to shorter term time frames, which moving averages will help you determine the trend better, looking a little bit at the VWAP in there, different moving averages, the importance of volume, of short sales and short squeezes, how to determine that. But anyways, it's available on Amazon, so just look up my name or the title, and if you're in a country that Amazon doesn't ship to, then send me an email at support and I'll get one out to you. Yeah, thanks for mentioning
it. Guys, I definitely recommend it, and just to reiterate, I have no affiliation with Brian Shannon or Alpha Trends other than we're just friends, and I'm a fan of his work. But from the bottom of my heart, guys, I think it's a must-read for sure. Particularly the stuff about the multiple time frames. I mean, it's the title of the book, so obviously you're focused on that. But incorporating multiple time frames, and just the last question, if you could just touch on it quickly. I think the first thing you need to do is really define your time horizon, right? Are you trying to make money today? Are you trying to make money over the next couple of weeks, couple of months, right? So first, define your time horizon. See at what what's your sweet spot? Are you looking at 30-minute charts? Are you looking at daily charts? And then that whole incorporating multiple time frames is then taking it one level higher, right? So if you're a longer term investor looking at weekly charts, use that multiple time frame and look at monthly charts to get that structural perspective. If you're a day trader looking at intraday charts, look at daily charts to get that longer term structural perspective, right? Would you agree on that, Brian? Could you touch on that?
Yeah, absolutely. In fact, the way I say it is that if you're a swing trader, you want to use a daily time frame going back about a year or so to one, identify the trade idea. You're not looking to buy based off the daily time frame, but you're looking at it and saying, okay, what's the overall bigger picture so I can get behind a bigger move. And then from there, you would drill down to a 30-minute time frame that goes back maybe 30 days. And in there, you start to plan your trade. You look at your risk reward, and it's not always just 30 days. Sometimes you're going to have to go back 45 days to find the most pertinent information to develop that risk reward and say, where's the potential that it can go? One, where has it come from? That tells me what my stop will be. Two, where does it have the potential to go? That gives me the basis of the risk reward. And then to drill down to shorter term time frames and set alerts based on a 10-minute 10-day chart or a 5-day, 5-minute chart, and that's where you fine-tune your timing. So that's for a swing trader. An investor might start out with a monthly chart or a monthly or weekly chart that goes back 5-10 years, and then their intermediate term time frame where they're looking to establish their risk reward would be a daily time frame. And then their short term where they're entering might be a 30-minute time frame. So it depends on what your personal objective is, and that's one of the most important things. People will say, are you bullish about the market or are you bearish? And well, it depends. I don't know. I heard you talking to JB yesterday about the Josh Brown, that is, talking about the definition of a bear market down 20% and how ridiculous that is. And I agree. To me, a bear market it's an environment where it's easier for stocks to go down for a period of time, where are more stocks going down on a daily basis, or more the direction of a 50-day moving average. If the S&P is below the 20-day moving average and it's declining, it tells me the average stock over the last couple months is declining, and that's an bearish environment for stocks right now. So it's time to be more careful or be on the sidelines, or start looking for, as Joe Fahmy said, what are the next leaders? Who's leading the way? What are the first 52-week highs? What are the stocks that are popping up with relative strength? What about the volume-weighted average price since this downtrend began? How many stocks are above that? How many are below it? So obviously we can go on and on and on and on, but I think that where most people tend to go wrong is to overcomplicate it, which is why I'm always so adamant about only price pays, and that most of your analysis should come down to price action for what it is that you're trading.
I love it, Brian. I've been a huge fan of yours for a long, long time. Longer than a lot of people on this list of speakers today and yesterday, which I think says a lot about you, because we've got some serious talent, on this list. So I really do appreciate you coming and taking some time out. Brian is lucky enough to live in Colorado, and it is right in the heart of ski season. So I appreciate you taking a few minutes to share some thoughts with the audience.
Well, hey JC, I wish you were here with me, because I'm headed up to the hill right now. It's starting to get a little bit warmer, and I'll see you here next month for some turns on the slopes. And thanks for putting this together. You've got some great speakers still coming up, so everyone should stick around. And thanks for taking time out of your day today.
You got it. I will see you in Colorado.